But let's first concentrate on the big news that we have got. Just about a few hours ago, the meeting at Doha did not yield the output freeze that was widely expected and priced in. We're being joined by several experts, and in a bit our in-house expert will also join us. Edward Morse, Global Head Commodities at Citi, and Mark Keenan of SocGen are joining us now to tell us how crude might pan out from here on. Good morning to you, Mark, and good evening to you, Ed. Thank you very much for staying up for us. So let me not keep Ed for too long. What's the sense you're getting now? Are we going to see crude tumble even below $30? Is it going to be a long tumble down?
I don't think it's a long tumble down. I think the retreat that we've seen should have been expected. It's sort of tapered off already. We're waiting for European and U.S. markets to open. I don't think it'll go anywhere near 30. But there was a lot of froth in the market based on expectations that this was for real. There were no real reasons, no real good reasons to think it was for real. We've had statements from the Saudi deputy crown prince saying all along that there was not going to be a deal. The market didn't want to believe it. Maybe the negotiators didn't want to believe it, but they certainly have to now. The market still has seasonal weakness ahead of it. There's still refinery maintenance. The big ramp up in refinery demand for crude is still a good month or 6 weeks away. That should be very constructive for the market once we hit the summer. And news like the news today also of Kuwait workers going out on strike are kind of a reflection of how the market can turn back to strength, because the underlying balance between supply and demand is very narrow, maybe 1.5% at worst. So this is going to be a short-term decline in our judgment, and things will become much more constructive by June.
Okay, our in-house expert Manisha Gupta has also joined us. Over to you, Manisha.
Thank you so much for that, Lata. Well, absolutely, as Edward was pointing out, it really has been a knee-jerk reaction and quite expected, really, because before the meeting started, it was quite clear that Iran was not going to be a part of this meeting. And unless Iran was a part of it, most of the other producers, of course, the Saudi Arabia, did not want to reach any agreement there. Edward, as you said, that until June, we are going to look at some softness continuing into the prices. And we have seen, Feb see a low of almost $30 a barrel. Are we going to those kind of levels in the next couple of months?
I think it's highly unlikely. The market tested those bottoms. I think market participants are well now understanding that whereas the Doha kind of meeting might have been necessary in December and January, as we get closer to the summertime, it's less and less necessary anyway. So I think you can never tell where financial flows are going to go, but there's no really good reason to think at the moment that there's significant bearish news ahead. Having said that, I would note that there are three areas of potential increase in supply. There's Saudi Arabia itself, and following the thoughts of Mohammed bin Salman, maybe they will try to put a lot more oil in the market. There's a neutral zone between Saudi Arabia and Kuwait with 500,000 barrels a day of capacity shut off on a political dispute. And there's Libya, where it looks as though there's a potential, at least, for the new unified government in Tripoli to get some traction in putting maybe as much as 500,000 barrels a day on the market. We think these are low probability events in all cases, but the markets could respond if these things happen.
Well, absolutely. Mark, coming to you with the next question then. The U.S. output continues to be on the higher side. Iran wants to continue to boost output until they reach the pre-sanction levels. And of course, you have the Saudi Arabia, Russia, which are not going to cut output if all the other producers continue to pump output on the higher side. So what's your sense on how much of a demand-supply mismatch are we headed for this quarter as well?
Well, our view is that the market remains fairly well supplied, certainly for the first half of this year. But what's quite interesting is that if we look at the U.S. fundamental picture, specifically the supply of shale oil, we're starting to see quite meaningful signs, certainly since December, of supply decreases in a lot of these key shale-producing regions. And that sets us up very much in the second half of this year for a much more balanced supply-demand outlook and a more stable base in prices forming, which sets us up ultimately for higher prices for 2017 and 2018. So really the situation that we've had recently with Doha, this retracement today has removed a lot of the speculative fluff in the market. Perhaps if it wasn't for the supportive elements coming out of Kuwait with the strike and the tightness in the North Sea, we would have had a bit more weakness. But we've realigned ourselves really very much to where we see prices fundamentally valued for this time of the year, ahead of this ultimate rebalancing of the U.S. supply.
Okay, so Mark, therefore, what is a low, a near-term low, and what is the range for this quarter for crude?
Yeah, we think that Q2 of this year we're going to average basis WTI about $36 on average. I do not think we're going to go down to the low 30s unless there's a broad risk aversion across the asset class linked to some more macro, more wider signal. So around $36, and then in Q3 and Q4, modest increase in terms of quarterly averages up to around $38 to $40 on average.
All right, Mark, Keenan, Ed Morse, thank you very much for joining us with your thoughts this morning and this evening for Ed Morse.